The median price in Brisbane is $871,000. That's up 80% since March 2020. So naturally, the question I keep getting is, can it keep going? I'm Angela, I work at Palise Property, and a part of my job is staying across the numbers, the market shift, and what our clients are actually seeing on the ground. So I've been looking at the data, the trends, and the signals coming out of Brisbane right now. Let's get into it. Since the start of the pandemic, Brisbane's property market has outpaced almost every city in the country. Capital growth has reached 78.8% since March 2020, an insane figure that I believe reflects how resilient and in demand the market has been over the past few years. In 2024 alone, values in Brisbane rose by 10.44%. That's more than 6 percentage points above the national average of 3.82% and well ahead of markets like Melbourne, which only recorded 13.2% total growth since March 2020 and is now more than 6% off its peak. For comparison, national property prices have increased by 45% over that same 4-year period. But we've entered 2025 on a different note. The start of the year has been relatively quiet, which, to be fair, has been expected. After multiple interest rate rises in 2024 and a tightening lending conditions, a temporary dip in activity always felt inevitable. According to PropTrack, Brisbane saw only a 0.08% growth in January 2025, which I think aligns more with broader economic hesitation than any real weakness in the market itself. And I don't think that hesitation will last long. The RBA made its first cash rate cut in February, bringing it down to 4.1%. Based on the latest forecast, more cuts are likely to follow throughout the year. As borrowing power begins to improve, we could see demand return, particularly in tightly held markets like Brisbane, where supply has remained consistently constrained. Vacancy rates are still sitting at 0.8%. which is not only well below the national average, but also one of the lowest readings in the country. Over the past year, housing supply in Brisbane was 34% below the 5-year average. Even now, listings are 4.4% higher than they were the same time last year, a relatively small increase compared to places like Canberra and Melbourne. Overlay all of that with major infrastructure projects already underway in preparation for the 2032 Olympic Games, and it becomes clear why so many investors are still watching Brisbane closely. We've seen this kind of momentum before. Ahead of the 2000 Sydney Olympics, property prices in Sydney rose by roughly 60%. In the 5 years after the Games, they jumped another 104.9%. Brisbane also saw a significant uplift following the G20 summit in 2014, with values rising by 112.7% between 2003 and 2015. So yes, Brisbane's growth since the pandemic has been strong, but the real question now is whether or not there's still room for more. To answer that, let's take a closer look at the driving fundamentals and whether they're still in place. When you break it down, Brisbane's strength over the past few years has come down to a simple set of fundamentals: steady population growth, a tight rental market, and a long-term pipeline of infrastructure investment. And right now, none of those drivers have gone away. Queensland continues to attract strong interstate migration, with many people relocating for affordability, employment, and lifestyle. That movement has been consistent since the pandemic. And while other states are seeing inflows slow, Brisbane is still holding on. For a city with limited housing stock, this kind of demand puts pressure on the system quickly. We're already seeing that play out in the rental market. Vacancy rates in Brisbane are sitting at 0.8%, lower than the national average and among the tightest in the country. That figure has barely moved over a year. Properties are being leased quickly, competition among renters remains high, and rental prices are continuing to rise as a result. That rental pressure is also a clear signal of how constrained supply is. Over the past year, Brisbane's housing supply was 34% below its 5-year average. And while there's been a slight increase in listing, up 4.4% compared to this time last year, it's still modest when you look at other cities. Canberra, for example, saw a 30.7% increase in listings over the same period, while Melbourne was up 16%. Brisbane just hasn't had the same lift. The result is a market that's still tight and likely to stay that way. New housing supply takes time to deliver, and even with some projects underway, it's not enough to meet the current or projected demand. With population growth continuing and infrastructure projects pulling more attention to the city, that imbalance doesn't appear to be easing anytime soon. And that's the real crux of it. You've got a strong demand, limited stock, and very little breathing room in the rental market. Add falling interest rates into the mix, and it doesn't take much to see how quickly things could start moving again, especially when you throw the infrastructure pipeline for the Olympics into the mix. We're not just talking about 1 or 2 upgrades here. This is long-term city-shaping work that's already underway, and it's likely to have meaningful impact on livability, connectivity, and ultimately, property demand. Take the Brisbane Metro, for example. It's a project designed to improve public transport across the city, reducing congestion and connect the key hubs more efficiently. Then there's the Cross River Rail, which will add new stations and create faster access between employment precincts, schools, and residential areas. And on top of that, Queen's Wharf is set to become a new lifestyle and entertainment precinct right in the heart of the CBD. These projects aren't just about the Olympics. They're about how Brisbane functions for decades to come, and that has flow-on effects for the property markets in the surrounding suburbs. Improved transport usually opens up pockets of value in areas that were previously overlooked, while big commercial developments tend to attract more people, more businesses, and more attention. And with 8 years of planning, development, and delivery still ahead, Brisbane is only just getting started. So with all of that on the table, the supply constraints, the population growth, the rental pressure, and the infrastructure build-up, the next question is pretty straightforward. What do you actually do with this information? Is it still worth investing in Brisbane right now, or has the window already passed? From where I'm sitting, I don't think the opportunity is gone. Even though the market came out of the gates a little slow in 2025, that doesn't mean the story's over. If anything, this pause might be the breather before the next leg up. I believe we're now in a holding pattern, not a downturn. Buyers are still cautious, which makes sense after the rate hikes of the last year. But with the RBA already making its first moves in February and the major banks forecasting further cuts throughout the year, we're likely heading in a different interest rate environment altogether. When borrowing power improves, demand usually follows. And in a city where supply hasn't caught up, that's when momentum tends to return quickly. Forecasting from the big 4 banks are already pointing in that direction. Westpac and CBA are predicting a drop to 3.5% by December, while NAB and ANZ are sitting slightly higher at 3.6%. If those forecasts hold, we'll likely see more people running the numbers and re-entering the market as conditions become more favorable. Even in conservative scenarios, so no further rate cuts, slower migration, SQM research is still forecasting growth of between 4 to 8% in Brisbane this year. But the more probable scenario, based on current trends and bank forecasting, is 11 to 16% growth through 2025. The other factor here is accessibility. As borrowing capacity lifts, some buyers will find themselves able to stretch into higher price points again. That creates opportunities in parts of the market that have been quieter in recent months, particularly where stock is limited and competition could return fast. What we're also seeing now is a tilt towards affordability. Many investors are looking at lower price properties, not just because of budget, but because yields are holding up well and the competition hasn't fully returned yet. KPMG has forecasted that units will outperform houses in 2025, 4.56% growth versus 3.3%, which gives some weight to that strategy, especially in inner urban areas. Regional Queensland has also stayed relatively resilient, posting 79.1% growth since March 2020. But longer-term performance still leans heavily in favour of capital cities and houses. Over the past 30 years, houses have outperformed units by 146.4%, and capital cities have outperformed regional areas by 139.2%. So while there's logic in the affordability play, there's still strength in the fundamentals of metropolitan growth. All of this paints a pretty clear picture. The opportunity hasn't disappeared. It's just become more nuanced. And if conditions ease the way they're expected to, the second half of 2025 could look very different from the start of it. I hope this helps, and I'll see you in the next video.